This video will give you an overview of Chapter 13's capital budgeting. There are 5 capital budgeting decisions. The first one is cost reduction decisions, which ask the question, should new equipment be purchased to reduce cost? Expansion decisions, which ask, should a new plant or warehouse be purchased to increase capacity and sales? Equipment selection decisions, which ask which of the several available machines should be purchased. Lease or buy decisions, which ask should new equipment be leased or purchased. And finally, equipment replacement decisions, which ask should old equipment be replaced now or should we wait until later? These decisions can fall into 2 categories. Screening, which means the decision has to pass a certain hurdle, and that hurdle usually is the required rate of return. Or preference, and that's going to be where business decisions have us choosing among alternatives or competing courses of action. Then we have the 4 formulas that we will use throughout capital budgeting decisions. To help you better understand how to use these, in a few moments we will do a comprehensive problem that I created that incorporates all 4 formulas, so to better help you understand how to use each of the formulas, when to use them, and their differences. Now, the first method we use to help us decide should we go ahead with the business decision is payback period. The payback period equals the time required to recover the cost of the capital investment from the net annual cash flow produced by that investment. So normally, the more preferred alternative is going to be the payback period that is shortest among alternatives. And that's because the shorter payback period will give us our cash quicker and release it so we can use it to invest in another project. And the shorter payback period helps reduce risk, namely risk due to equipment becoming obsolete or risk due to economic changes. Now, this is not to say that the shorter payback period is always the best decision, but because of those 2 reasons, many times it is. Another method we use is the net present value method. This compares the present value of a project's cash inflows with the present value of the project's cash outflows. The net present value method discounts the net cash flows to their present value and then compares the present value with the capital outlay required by that investment. It then calculates the net present value, or the NPV, which is the difference between the present value of net cash flows and the required capital. If the NPV is 0 or positive, that proposal or project will be acceptable. The NPV also emphasizes cash flows and not accounting net income. And because it does not emphasize accounting income, depreciation is excluded because it's a non-current cash outflow. Also, discounted cash flow methods automatically provide for a return on the original investment. Initial investments occur at the end of the periods, and all cash flows generated by the investment are immediately invested at a rate of return equal to the discount rate. Now, that discount rate or required rate of return is also called the hurdle rate. That's equal to the cost of capital plus a risk element. The cost of capital is equal to the weighted average of the rates paid on borrowed funds as well as the funds provided by investors in company stock. So when a company is determining its required rate of return, it wants to make sure at a minimum it equals the cost of its capital or borrowed funds, and it wants to also consider the risk environment. And if there is uncertainty about risk, it's going to increase the required rate of return so that it can take care of any type of risk we may encounter. Another method we will use for determining should we move ahead with a capital budget project is the Project Profitability Index, or PPI. This allows the comparisons of alternative projects, which takes into account both the size of the investment and its discount future net cash flows. Another method is the internal rate of return, or the IRR. This is the discount rate that will cause the net present value to equal 0. If the IRR is equal to or greater than the required rate of return, the project is accepted. It works well if cash flows are identical each year. And again, if the IRR is equal to or greater than the minimum required return on rates, then the project is acceptable. Advantages of the net present value over the IRR is that the net present value method is often simpler to use, and the internal rate assumes that inflows can be invested at that rate. And sometimes that rate is very high and therefore very difficult to find other projects that are also at that same rate. Another method that is used is simple rate of return. This is the rate of return computed by dividing a project's annual incremental accounting net income by the initial investment. And again, the annual incremental accounting net income is accrual accounting net income. So it does not involve discounting cash flows or the time value of money. And then finally, the annual net cash flows or cash savings equals the annual cash inflows less the annual cash outflows. So let's see how we use this information with this comprehensive problem. Let's assume that Brooks Shipping Company is considering investing in new equipment and has the following information. The initial investment is $1,200,000. Working capital is $250,000. Estimated useful life is 10 years. Estimated salvage value is $100,000. The discounted rate or required rate of return is 12%. We're also given the anticipated yearly revenues and expenses. So our revenues from operations is $1,700,000, and we have the four operating expenses: salary, rents, insurance, and depreciation. We have to calculate the project's payback period, net present value, internal rate of return, simple rate of return, and profitability index. The cashback period is equal to the investment required divided by the annual net cash inflow. Well, in order to get the annual net cash inflow, we first have to calculate the net operating income. We get that by taking the revenue that we were given, $1,700,000, and subtracting the four expenses. And so that gives us $180,000 net operating income. And remember, this is the accrual-based net income. We want the annual net cash inflow. So that's going to take our net operating income of $180,000, and we have to add back all non-cash expenses. And so if we go back to the information and look at our expenses, salaries, rents, and insurance are all cash expenses. The only non-cash one is going to be depreciation. In this problem, we're assuming that all expenses are paid for as they're incurred. So therefore, our cashback period is the initial investment of $1,200,000 plus the working capital of $250,000, which is a total of $1,450,000, divided by the annual net cash inflow of $300,000, which again was taking the net operating income and adding back depreciation to get the $300,000. So when we do the formula for the cashback period, our cashback payback period is 4.8 years. Now remember, our useful life is 10 years. So we are going to recoup our investment within 4.8 years, or less than half of the useful life of this equipment investment. So that's a pretty good investment, and most companies would say accept it. But because this does not look at the time value of money, this should not be the only method that we use to make our decision. So the second one says let's use the net present value method. So you can see here in this table I've showed the initial investment, which is being invested now. So it's an outflow of $1,200,000 at a factor of 1. The working capital needed is also going to be invested now. So we have an outflow of $250,000 also at a factor of 1. Then we have the annual net cash flow. That's what we calculated above, the $300,000. So we're going to get this every year over the 10 years. So since it's coming to us every year, we're going to use the 10 periods for the useful life. 12% is our discounted rate. And because we're going to get this flow of cash every year, we're going to use the present value of annuity table. So going to our tables, go down to the present value table. Oops. Okay, I think that's a little better. Sorry about that. So again, 10 is our number of periods, and 12%, and we want to use our present value table. So 10 years, 12%. And we know this is our present value of annuity table because all the factors are growing larger than 1. So 5.650 is our factor. So you can see that's where I got the 5.650. Multiply that by 300,000, we get 1,695,000 inflow. Then the salvage value we're going to get at the end of the 10th year. So it's only one lump sum of 100,000. When it's a lump sum, we want to use the present value of $1. So we're going to go to the present value table of $1. Look at 10 years. Go to 12%, and that gives us a factor of 0.322. So take the 100,000 times 0.322, that gives us an inflow of 32,200. Then we're going to release our working capital at the end of 10 years. So that cash flow of 250,000 will use the same factor of 0.322. That gives us an inflow of cash of 80,500. Add all the present values, and we get a net present value. This is the key. It's a net present value of 357,700. Now I want to go back to the definition of the net present value method. And it says discounts net cash flows to their present value and then compares it to the present value with the capital outlay required. What that bullet says is that we're taking the present value, which is a factor of 1, of our capital investments, and comparing it to the discounted cash flow of our cash inflows here. And as long as it is a positive number, we will accept it. So the net present value, when you see the net present value, it's adding up the outflows, present values of the initial investments with the inflows. So since the difference between the present value of the net cash flows and the required investment and capital is positive, therefore we accept the project. Now number 3 wants us to calculate the IRR, which equals the investment required divided by the annual net cash inflow, which is also called the cash savings. So our initial investment is the $1,200,000 for the initial investment plus the working capital of $250. Divided that by the $300,000, we get a factor of 4.83333. It's running all over the place with threes, so we'll just stop it at 5 threes. So we know again we have a useful life of 10 or 10 periods. So we want to look up this factor of 4.833, and remember it's cash inflow of this $300,000 every year. So if I look at my present value of annuity, because I'm getting that cash flow every year, and if I look at year 10 and I keep looking until I find 4.833, this is the closest interest rate, and it's 16%. So that tells me my IRR, or internal rate of return, is 16%. And what this says, if we use 16% in calculating our net present value of annual cash flow, we would get a net present value of 0 as follows. So again, just like we did previously, we look at our investment, which is being invested now, our working capital also being invested, and look at our annual net cash flow of the $300,000 using that factor of 4.83333. That comes out to be $1,450,000 positive versus the negative $1,450,000. and gives us a net present value of 0. And then deciding whether or not to go ahead with this project, since the required rate of return is 12% and the internal rate of return is 16%, since the internal rate of return is greater, we would accept the project. Then number 4 wants us to calculate the simple rate of return, with just the annual incremental net operating income divided by the initial investment. So the annual incremental net operating income is our net income accrual basis of $180,000. Then we are going to divide that by our total investment of the $1,200,000 plus the $250,000, and that's going to give us a simple rate of return of 12.4%, and that is greater than our required rate of return of 12%. So even using the simple rate, we would say accept the project. Then the last one asks us to calculate the project profitability index, or the PPI, which is equal to the net present value divided by the investment required. So the net present value, we go back up to our number 2 where we calculated the net present value, $357,700, and divide it again by our investment required, $1,200,000 plus the $250,000. So we get an index of 0.24669. So if the company had a choice between investing in this project or another alternative, the company would choose the project with the highest PPI. So as long as this is the highest PPI among alternatives, we would use this one.